Retiring Well, brought to you by Centennial Wealth Advisory, financial advisors specializing in retirement planning and serving all of Northern Michigan. Retiring Well, helping you plan for a successful and comfortable retirement. Retiring Well, plan to retire well.
Hi, welcome to the December 2020 annual market update. Folks, Happy New Year, and boy, what a year it's been, right? If you look here, you got the S&P 500 for the year, ended up being up 16%, the Dow up 7%, and the NASDAQ 43, almost 44%. If you look at it just over the last couple of years, had you been in NASDAQ, it's literally almost double. This is just the S&P 500 over the last 1 year. You can see in March when it dropped to 34% in just a 2-week period. And then since then, it's been steadily on the rise all throughout the year. We had a couple corrections, 10% corrections in the fall, but hardly anybody paid attention to them. And now we're reaching all-time highs. This is interesting. You see in the blue, it's the S&P 500. In the purple, that's the S&P 500 with the equal weight. A lot of people don't realize this, but with the S&P 500, it's weighted. So the companies that are doing real big have a greater weighting. But if you give everybody an equal weighting, basically a 0.5%, you can see that of recent. That's doing real well. That's telling us that, for the longest time, it was a handful of stocks, basically those FANG stocks, Facebook, Amazon, Apple, Netflix, Google, and Microsoft driving the whole market, right? Because they had such a great weighing in the S&P 500. But now with equal weight, what we're seeing is a lot of breadth in the market, meaning a lot of companies are starting to do well. You see the high dividend stocks remain very attractive right now. Most of the growth has been in the growth stocks. Value stocks have, and not performed as well. But you can see right now the gap is quite great. There's probably going forward, this could or could not be a trend. You can see here the value versus growth all through this pandemic. Growth has way been outperforming value. But of recent here in this fourth quarter, value stocks start to make a comeback. Is this a trend? This is just the S&P 500 versus the BEU, which is basically everybody else except us in the world. And you look at this over the last 2 years, I say this, I'll say it again, we're much more globally connected than we realize. You can see in with the pandemic, all of us had taken a big drop and have since seen some recovery. Even, this is interesting. If you take the top 10 sectors of the S&P 500, you take the median one, 95% of the stocks in that median sector are up above their 200-day moving average. This one happens to be the worst sector of the 10, and you can see 80% of the stocks in that sector are above their 200-day moving average. So, again, the breadth of this market coming back is more now with everybody, not just those handful of stocks. This is just GDP growth. You can see in the first quarter with that pandemic, being that it was just the last 2 weeks there in March, we saw a 5% drop. Most of it was felt in the second quarter, dropped 31%. They had a huge recovery in the third quarter with all that stimulus money and everything else they threw at this. And now the latest estimate for the fourth quarter is 10%. Folks, if that holds out for the year, it looks like we're going to average about 1.9%. Who would ever thought with the pandemic hitting that we would end up having a year like this? Unemployment, with the pandemic, it got as high as almost 15%. Now we're about half of that. That's been a good thing. Now that's starting to slow down. I'm going to talk a little bit about this more, with these closing downs, but, we're still, even as we sit here, historically pretty high unemployment rate. You can see, the continuing claims for unemployment, they were steadily going down, and now all of a sudden are starting to kind of tick back up a tad bit. So something we're definitely want to be paying attention to. Inflation. We've had low inflation for quite some time. It dropped considerably with the pandemic, and now is starting to climb back up, but still very low, at just low over 1%. The Feds got together in December, and they didn't change the rates. They're talking about leaving the rates low for the next couple of years. That's going to bode well for a lot of corporations trying to get back to recovery. They're still buying bonds. They're doing everything they can to keep this thing propped up. But they were very much encouraging the government to get some stimulus money out there, especially to small business. Jerome Powell said, now that we can kind of see the light at the end of the tunnel, he continued, it would be bad to see people losing their business, their life's work, in many cases, or even generations of work, because they couldn't last another few months. Still, Powell is hopeful Congress' latest round of negotiations will yield further support. Well, they went back and forth, and then, finally, on December 27th, we get a bill. We get a stimulus bill, $900 billion. And just in time, as a matter of fact, because unemployment benefits were going to run out at the end of the year. People have dipped well into their savings. Something had to be done very quickly, and at basically the 11th hour, they finally get the stimulus package through. As far as I know, as of right now, I think checks are going out. $600 per person for anybody that had income, I think, under 75,000. And then more PPP loans out there for small business to take advantage of it if they can show that they've been very much hurt in this. So glad to see that. I still, there's so much small business, especially restaurants, that have been hit so hard in this. It'd be nice to see them start to get some help here. And folks, we finally get a Brexit deal with the EU. Folks, this has been going on for 4 years. Remember, back in 2016, and all the speculation took place as far as, was this going to be a hard exit or a soft exit? Finally, on Christmas Eve, they finally reached a deal, and it was kind of anticlimactic. Haven't heard a whole lot about it, but they struck a deal. This is Boris Johnson giving, the thumbs up. He says, we haven't taken back control of our money, borders, laws, trade, and our fishing waters. No, he says we have taken it back. The deal is fantastic news for families and businesses in every part of the UK. We have signed the first free trade agreement based on zero tariffs and zero quotas that have ever been achieved. I didn't realize that in all their negotiations, it was the fishing rights that was probably one of the bigger ones that was the issue. But good to see that has happened. So, we'll see how it bodes well for the UK as they go forward. But for the most part, they've struck a deal. U.S. wages and salaries growth, you can see over the last 10 years, took a dramatic hit with the pandemic, but is slowly coming back, not quite to where we were pre-pandemic, but on the rise. Oil futures, or the price of the barrel, I mean, for some time has been running around about $35 a barrel. You got to understand that these oil companies can't make money until it gets right around $50 a barrel or more. And just of recent here in this last quarter, we've seen it now get pretty close to that. So this is going to bode well for the energy sector. They've been wanting to see this for quite some time. If you look at this is just gasoline demand. From the pandemic dropped considerably. It was starting to climb back up to pre-pandemic levels, and then of recent has kind of tapered off. I think this has to do with all the recent shutdowns and things of that nature, but we're going to continue to watch this to make sure that that's on the rise. You look at the energy sector itself, it's been 2 years since the 50-day moving average is crossed over and better than the 200-day moving average. So, the energy sector, which is taken a huge hit in this pandemic, is showing some signs of recovery. This is just the CRB commodity index. It just tracks a basket of 19 commodities. You can see with the pandemic, it took a huge hit and is now slowly back on the rise, which is a good thing. Median sales prices of houses sold in the United States, you can see for the last couple of years has been, for the most part, flat. Although, when I look in our own backyard, in our area, it seems like prices have been on the rise. But you look at this nationally, and that's not necessarily the case. The monthly supply of houses in the United States, you can see, took a huge hit. And then all of a sudden now we're seeing just an uptick in that. So that's a good sign. This is the US dollar index since 1973. We've tracked our currency with all the other world currencies, and we baselined it at 100. You can see with this pandemic, it's dropped now down to around 90. This is not good. I think with all this money that we printed, it's putting downward pressure on the dollar, but it happens to be a bright light for manufacturing because it makes our exports less costly. But this is, with all the more stimulus money we're throwing at this, we're going to continue to pay great attention to this because this is not something we want to see on a trend downward for very long. When we've seen the dollar be in a bear market territory like we've seen of recent, you can see where other asset classes have done very well. Since 1973, where the dollar's been down maybe 15%, gold's been up 23%, and then you can see equities, commodities, and treasuries. So typically when the dollar's been in a bear market territory, these other asset classes have done well. Just as U.S. consumer sentiment, you can see with the pandemic took a huge hit, slowly climbing back, but hardly where we were at pre-pandemic. There's still a lot of people out there hurting. If you're one of those people that are in that unemployment numbers, you're not feeling good. If you're that small business person who's, being closed down this last quarter, you're not feeling good. So although it's been on the uptick, we're not quite where we need to be. Consumer spending, this is looking at it over the last 10 years. Again, huge hit with the pandemic, but slowly climbing back. You can see just as how people are spending their money. Since the pandemic, you can see groceries and home improvement have been on the rise. Stands to reason. You look at dining out, down. People are buying groceries, they're eating at home. Stands to reason. And because they're at home, they're doing projects around the house. This is just small business optimism since 1986. They've been, tracking this. You can see took a huge hit with the pandemic. Sharply increased, and now of recent took a downward tick. And I think that has to do maybe with some of the recent closures, like I said. So we're going to continue to watch it. Still pretty good overall, but it just shows you how this with the pandemic, how indiscriminate this has been, that some have taken such, it's basically created winners and losers. Some have been able to sidestep this and adjust accordingly. Some have not been able to do that.
Hi, my name is Jack Clunner, and I'm a financial advisor with Centennial Wealth Advisory. My wife and I moved up here 13 years ago, and we have really enjoyed raising our 4 children in the beautiful northern Michigan country that we have. If you've been watching the show for a while, you know what we specialize in. If you are at retirement or near retirement, give us a call. Call the number on your screen. We can help go through all the different aspects of planning that are involved in retiring well. So I look forward to hearing from you.
U.S. manufacturing index, when it's above 50, we're in expansion mode. When it's below 50, we're in contraction mode. You can see that, it got up in expansion mode and it's remaining there. And again, a lot of what's driving this is that downward pressure on the dollar, making our exports less costly. This is just a non-U.S. manufacturing index. You can see also in expansion mode, but of recent kind of taking a downtick. Again, probably has a lot to do with some of the recent closures and the like. This is just the S&P 500, the PE ratio. This is the price of the market divided by its earnings. Historically, it's traded at about 16, 17 times earnings. With interest rates being low pre-pandemic, it was running right around 24, 25 times earnings. But now you can see of recent, just this year, getting very high. And this is what you're hearing a lot of news about, is it getting so high that maybe we're getting into, bubble territory? Well, if you look at this chart, PE ratios haven't been this high since the dot-com bubble. So, that might be indicative of maybe a bubble coming. Valuations are certainly high. You look at this, with the members of the S&P 500, the percentage in the red that are PE ratios above 20 is very high, around 60%. Those that are below 15, indicated in the green, is like around 20%. So, do we have some mild overvaluation here? Absolutely. But if you look at this chart, this is quite interesting. You can see on the left, it's the PE ratios. And in the bottom is where we've had interest rates. Well, where we've had interest rates maybe be 15%, okay, that justifies much lower PE ratios, like right around 10. But you look at that yellow dot where we find ourselves right now, is interest rates being so low, it can support higher PE ratios. If you look at that curve, we're well within that curve. So, that's what people are saying. If the Feds are going to keep interest rates low here for a couple years till we can get to, a little bit more recovery, we can stand to have PE ratios be a tad bit higher. What's interesting is if you look at the forward PE ratio, though, that is, when we're looking at PE ratios, we're always looking in a rear view mirror. But if you look forward at where earnings are expected to go and where the valuations are today, it's expected that maybe 1 year from now, in the fourth quarter of next year, PE ratios will be right around 24, which is pretty close to where we were at pre-pandemic. So if you look at it that way, we're not necessarily in overvaluation territory as long as those earnings continue to hit estimates or expectations. Let's put it that way. Just looking at other indexes and where they are as far as PE ratios, you can see the NASDAQ, a year ago was at about 27, as far as price to earnings. Right now it's at 39, which seems very high. But again, if earnings hit expectations, they might be only about 32 at the end of the year. Same thing with S&P 500, really not in, super overvaluation territory. But the one that's, that keeps drawing my attention is the Russell 2000 index. That's basically small company stocks. You can see a year ago that was at 37.98. If you look at estimates going forward over the next year, it's at 80. Folks, that's pretty high. So we've heard, in the news, this recent surge in small company stocks doing very, very well, valuations going up, but earnings are not going to support it, I don't think, going forward. So we're going to want to pay great, great attention to this. This is just U.S. corporate profits over the last 10 years. Again, see, it took a huge hit with the pandemic, but now corporate earnings are getting back to pre-pandemic levels and growing. If you look at this chart going forward, what the profits forecasts are over the next 3 years, it's going to be trending upward. So that's a good thing, because with increased earnings, it can justify higher valuations. This is just the volatility index, or the VIX, or what we call the fear gauge. It's just an algorithm to decide where the market's going to be the next 30 days, to the good or bad. So a VIX rate of 20 means they expect the market to be 20% to the good or 20% to the bad over the next month. Historically, it's been around 20. As of recent, it's at about 22. So we're not a high fear gauge here, and not necessarily complacency. Pretty close to where we've been. This is a Jefferies Global Risk Appetite Index. You can see with the fall, which is in the red, we were, there was a lot of risk aversion, but of recent now, it's in the risk-taking mode. People are getting in. Like I said earlier, with the breadth of the market, it seems like all stocks are starting to, feel the recovery or are seeing some uptick. So people are getting in. This is the treasury rates. You can you see very low, if all the way up to 3 years. You get to 5 years and you're getting just under 0.4%. The 10 years still under 1%, and then the 30 year at just a little over 1.6%. Now the 10 year is the one we want to follow. It's the 10 year that tends to affect mortgage rates and this and that. Right now, real estate is doing real well because the mortgage rates are so low. But as the 10-year treasury starts to rise, I think we're going to see, mortgage rates start to rise. We'll see what the effect is on real estate accordingly. So we got the vaccinations, really good news. It's been being rolled out. I thought this is kind of an interesting chart to kind of see, what they're expecting this rollout to kind of look like. You can see with December, they're going to, prioritize long-term care facilities, healthcare workers, right? And then in January and February, we're going to get to the essential workers. February, March, April, it's going to be those high-risk, people with medical conditions. And then we're not really going to start to get, access outside of that till we get to maybe April. And then that's even if people decide to get it or not. So we'll see how that, continues to roll out. I know, with some of the earlier vaccines, there's 2 doses and they have to be kept, cold. I think AstraZeneca is coming out with one that doesn't have to be kept cold and is just a 1 dose. So again, as they continue with this rollout of all these vaccines and the widespread access, we'll see how that plays out. You're looking at the strategist that's in the green, what they're expecting, in the market, and you can see that expectations are good. Strategists are starting to price in a good year for next year. If this vaccine rollout continues to play out well and earnings continue to be on the rise, it's conceivable we could continue to see this market do well. You look at the number one, say top 3 concerns of strategists out there, though, is, number 1, virus mutates and dodges vaccines. I think we just heard there's a new strain out there. Now, I don't know if this vaccine is able to treat that as well, but obviously not good news if we get a new strain out there and this vaccine finds itself ineffective in dealing with it. Their second major concern was the side effects to these vaccines. I know I heard some people having some high side effects to the vaccines. I haven't heard that being the predominant thing though yet, so we'll see where that goes. And then another concern they had was enough people refuse to take the vaccine, right? Which hampers our ability to get back to normal as well. So we'll see how those concerns play out. So Tesla finally gets to be in the S&P 500. I think it opened up on December 21st, and you can see at the bottom there, their market cap, $622 billion. This has been a long time coming. I think the hesitancy for them to let Tesla be in the S&P 500 is it carries such a great market cap that if it takes a huge hit, it hits it hurts the whole S&P 500 index as a whole. Like I said, remember it's a weighted index. So, if it's a company that holds a great weighting and they take a good hit, that really affects that index accordingly. So I think that's where the hesitancy has been, but they couldn't keep it out of there for long as far as the market cap goes. U.S. restaurant occupancy, you can see that, it was on the climb. If recent is kind of dropped now with all these shutdowns, is still well below where it was pre-pandemic. And same thing with traveler output, hardly where we were at pre-pandemic. So, there's probably a lot of pent-up demand in those areas. So if we can get that vaccine rolled out and the economy starts to recover, I bet we're going to continue to see those climb. I thought this interesting, just the natural Christmas tree sales. You look at the prior, few years, and you can see it was at an all-time high, for these weeks during Christmas. That just goes to show you, people are home, they're spending more time at home, and then they're, not only are they making home improvements, but they're taking care of things like this. So what's our roadmap going forward? Again, we want to stay invested. With all this stimulus money that they're pouring into this, what the feds are willing to do, you want to be invested. So as this market continues to show signs of recovery, we want to be able to take advantage of that. But right now, I think all eyes are on Georgia. What happens with those 2 Senate seats? Is there going to be a balance of power shift here? If the Democrats pick up those 2 seats, now they have all 3 branches. Now, not being political, but with that, that creates a little bit of uncertainty because the markets don't know what they're going to get. And they really like gridlock. They like both sides to have to work together. They don't like to see a lot of change. So could there be a short-term reaction to that in the market if they pick up those seats? Sure. But on the other hand, it's been the left that has been looking for even greater stimulus money, which I can't argue has been great fuel for this economy. So although it might be short-lived, I think with the money that they're willing to put at this, it's going to bode well for the markets throughout the year. Now, I have some concerns as to all this money we're printing, what that means down the road. I think we all do, but in the short run, we can't argue that all these measures they've been putting in are absolutely keeping this market propped up. Again, we want to watch how this vaccine rollout turns. Right now it seems very positive. But if this should turn negative anyway, that could be a game changer. So we're going to want to keep our eyes on that. So we want to be invested, but I dare say we still want to be conservatively postured. Should we get a good rollout with this vaccine and corporate earnings continue to be on the rise, and it looks like we're going to get to a little bit more normal by third quarter of 2021, I think we're going to probably see a case for being able to dial up our equity exposure accordingly. So again, folks, I hope you found this valuable, very informative. If you have any questions, by all means, give us a call. Us advisors are always here willing to answer those questions for you. So thank you for joining.